Hello and welcome to our discussion today on investing basics. My name is Danny Wilson and I'm a learning and development advisor at Pinnacle Financial Partners. I'll be sharing some general investing information and best practices, but of course we are not providing legal, accounting, or specific investing advice. So before making major financial decisions such as putting together an investment plan, you should talk with a professional to get advice that can be tailored to your unique situation. Let's start by talking about the difference between short-term and long-term saving and investing. Typically, any money that you need to use in less than 5 years would be considered short-term savings, and money you can leave untouched for at least 5 years or more would be considered long-term savings. The primary concern for short-term savings is that the money is available and won't lose value. While regular savings accounts, money market accounts, and CD accounts won't earn you a ton of money, they also won't fluctuate day to day or go down in value. Plus, if they are on deposit at a bank, they are FDIC insured up to certain limits, and by structuring and titling the accounts in certain ways, you can maximize the benefit to cover very large sums of money. With certificates of deposit, just make sure the maturity dates match when you will need the money so that you do not have to pay early withdrawal penalties. Long-term savings are typically referred to as investments. Since the time horizon is much longer, you can take on a little more risk in order to maximize your potential earnings. While there's no guarantee, historically stocks, bonds, and mutual funds of various kinds have earned more than your typical savings account and have proven to be excellent long-term investments. Real estate has done very well over the years as well. We're going to take a deeper dive now on mutual funds in particular, and there are many different types of mutual funds that invest in a wide variety of investments, but the two primary types of investments that can be found within them are stocks and bonds, which will be the focus for the purposes of this discussion. Mutual funds allow for instant diversification beyond what many individual investors would be able to achieve initially by buying individual stocks and bonds. So the way it works is you put your money in each month, I put mine in, and then thousands of other people put theirs in as well. The mutual fund manager can take that money and invest it in the best stocks and bonds, depending on the type of fund that they can find, and instantly you would be invested in all of them by way of owning the mutual fund. The managers are the experts who spend all of their days and nights trying to determine the best companies to invest in, what strategy is best, which way the market is going, etc. That's called active management. Passive investing has grown by leaps and bounds over the last 20 years or so, though, and that is where the mutual fund manager invests the money to mirror a particular index, such as the S&P 500, the NASDAQ, or the Russell 2000. These are referred to as index funds, and the best news with those is that expenses are very low, and so you're not paying a fee for the active management, just for the administration of the fund so that it can continue to mirror whichever index it is following. There's always a debate over which way to go, either active or passive index funds, but many investors find that they like to have a little of both. Bond funds have historically had lower returns than stock funds over long periods of time, but they are thought of as being lower risk. That's because bonds are debt instruments where in essence you are loaning the issuer the money, and if things get tight, they have to pay that first before paying stockholders. There are many different types and qualities of bonds issued by companies, governments, municipalities, and they can be in the United States or overseas. The name of the fund will often reflect that. Stock funds are thought to be riskier than bond funds, but they have more upside potential. That's because when you own stock in a company, you actually own a part of that company and share in the profits and losses, same as with any other owner of any other company. Like bonds, there are obviously many different types and sizes of companies, both in the United States and overseas, which different stock funds will invest in. Then there are mutual funds called balanced or allocation funds that attempt to provide you with the best of both worlds by combining stocks and bonds within the portfolio, and this blended approach is another option that can meet the needs of many individuals. So, what are some of the things to consider when looking for a mutual fund? Well, there are literally thousands of mutual funds to choose from, so you sort of need to work your way down the list of things most important to you in order to narrow down your choices. And the appropriate type is probably top of the list because this is where your specific investment goals come into play. The type of mutual fund includes things like, is it investing in stocks or bonds, or some combination of both, or something else entirely? What are the fund's stated investment objectives? If it's a bond fund, what type of bonds does it invest in? If it's a stock fund, what type of stocks does it invest in? If it's a blended fund, what is the percentage of stocks versus bonds? And so on and so forth. Next, you'd probably want to consider the initial investment required. And while past performance is not a guarantee of future performance, it is an important indicator. Just keep in mind that when looking at past performance, the longer the fund has been in existence, the better, so that you can see how it has weathered a variety of market conditions. Be sure, too, to look at the fund manager's time on the job, since it's possible for a fund to have a great long-term track record that was accomplished by a manager who is no longer managing the fund. Similar to how every industry has companies who are considered to be the best of the best, the mutual fund company, also known as the mutual fund family, and its track record and reputation is another very important consideration. And last but certainly not least, on our list of things to consider when you're selecting a mutual fund are the expenses. Does the fund charge a front-end fee that's known as a load to buy into it? What's the annual expense ratio, which is a percentage of the money you have invested in the fund that is charged each year to manage and administer the fund for you? There are many studies out there that show how the fees charged are a leading indicator of overall fund performance, and of course it just makes sense to pay close attention to what you're paying for. Now let's transition a bit and discuss the most common types of retirement accounts. Each one acts as an umbrella of sorts that helps protect the underlying investments from taxes. The investments within the retirement account can be pretty much anything, but a lot would include the types of mutual funds we just discussed. First up are traditional and Roth IRAs. Now you see a chart here that compares a traditional IRA with a Roth IRA. So let's look at some of the highlights. With a traditional IRA, deductibility on your contributions may be limited, but typically you receive a tax deduction for the amount of money that you contribute for that year. On a Roth IRA, the eligibility to contribute to begin with is based on your adjusted gross income, and there is no current year tax deduction on a Roth IRA for your contributions. In both cases, the contributions are subject to the IRS annual limits. In a traditional IRA, the money grows tax deferred, whereas in a Roth IRA, the money grows tax free. Now this is a big difference because what that means is when you take the money out of a traditional IRA, you're going to be paying taxes on the entire amount, both your contributions and the earnings. Whereas on a Roth IRA, you do not have to pay taxes on any of it, not the contributions that you made because they were already taxed the year that you made them, and you do not have to pay taxes on the earnings either. If you take the money out prior to age 59 and a half, there is an early withdrawal penalty in both cases. However, the early withdrawal penalty only applies to the earnings in a Roth IRA. And with the traditional IRA, you are required to start taking an annual required minimum distribution at age 72, whereas on the Roth IRA, that is not required. Another option are 401k plans and 403b plans. 401k plans are employer-sponsored retirement plans where employees can contribute earnings up to the IRS-allowed limits, and the employer can choose to match a certain percentage of it. The tax treatment is going to be similar to that of a traditional IRA. 403b plans are also known as tax-sheltered annuity plans and are often offered by nonprofits, schools, and religious organizations. These plans work in a very similar fashion to 401k plans. Both types of plans typically have multiple investment options available, and they are excellent vehicles for saving for retirement. Not only are they convenient in that the money comes directly out of your paycheck, but most have some sort of employer match, which means free money for you. And who doesn't like free money? The next question I would ask is, how many of you are self-employed? Or how many of you have someone in your household who may be self-employed? If that's you or somebody you know, then there are a couple of retirement accounts that are designed specifically for small business owners, and they can be used in addition to or instead of traditional and Roth IRAs. The self-employed pension or SEP IRAs can be opened by anyone who owns a business, whether or not you have employees. If you do have employees, then you must contribute the same percent for you and each of them up to a maximum of 25% of compensation. Each year you can decide what percentage you want for that year. Only the employer can make contributions, however, the employees cannot. The other plan is called a Savings Incentive Match Plan for employees, also known as a simple IRA, and it feels more like a 401k plan but with lower administrative cost. Employees can contribute to it and receive a specified employer match. Only companies with fewer than 100 employees are eligible for it, however. These two plans are great options for any small business owner to consider. Of course, saving for retirement isn't the only long-term savings and investing possibility, and saving for college is one of the most common ones. Same as with retirement accounts, each of the college savings accounts you see on the screen acts as an umbrella of sorts that helps protect the underlying investments from taxes. The investments within these accounts can be pretty much anything, but a lot of them would include the various types of mutual funds that we've looked at. On a side note, when determining how best to pay for college expenses, remember that there are many scholarships, grants, student loans, and work opportunities out there too. So let's take a look at the Coverdell Education Savings Account first. The Coverdell Education Savings Account, also known as ESAs, can benefit children up to age 18 and longer if the child has special needs. This means you can contribute money into the account for their benefit up until that age. Anyone can fund it, but the parent or legal guardian maintains control of the account until the beneficiary child reaches age 18 or 30 if it's set up that way. Control passes to the beneficiary at that time. The amount you can contribute is limited, however, based on your adjusted gross income. There's no current year tax deduction, but the money does grow tax deferred and can be withdrawn tax and penalty free as long as it is used for qualified education expenses. This even includes expenses for kindergarten through grade 12 as well as college expenses. Withdrawal is mandatory when the beneficiary reaches age 30. The account may be transferred to another beneficiary if certain conditions are met. 529 plans are college savings plans that are state-sponsored, but you don't have to live in the state in order to use that particular state's plan. Anyone can open a 529 plan and contribute to it. Unlike Coverdell's, there are no income restrictions, age limits, or time limits for withdrawal. You can even open one up for yourself if you like. Money can be withdrawn tax and penalty free as long as it is used for qualified education expenses. This includes kindergarten through grade 12 tuition as well as any type of college expense. Control of the account stays with the owner always, and beneficiaries can be changed at any time. Both Coverdell ESA and 529 plans can play an important role in your overall financial planning if you have members in your household who will be going to college someday. So that concludes our discussion today on investing basics. I hope it has been helpful, and I know it's a lot to consider. If you have questions or would like to speak with someone about your specific situation, please feel free to reach out to your financial advisor or stop by your local Pinnacle office. We'd love to hear from you.